Well, good afternoon. Good afternoon and welcome to another of our webinar Wednesdays. This is edition number 365. So yeah, correct. If we would have been doing this every single day for a year, we'd be done. But we haven't. We've been doing it since 2013 and on a weekly or biweekly basis. And so this is number 365, kind of a milestone event, but kind of not. So well, again, good afternoon. I'm Kelly Bearden. I'm the director of the CSU Bakersfield Small Business Development Center, and I'm your host. And also, you're stuck with me as the presenter this time, kind of going back to the old times during the pandemic, to where we were on 134 consecutive Wednesdays live, and I oftentimes didn't have a guest speaker, and I don't today. So we're going to talk about a topic that we talked about during the later stages of the pandemic about the state small business credit initiative, which came out of the Treasury. We're going to explain all that. I'm going to give you my introduction first and then get into the meat and the potatoes. We are open to take your questions, so put your questions in either the Q&A in the chat box, and away we go. And it's great to be here today on November the 19th. 2025. So we're going to be jumping into a lot of the capital access options that you have, particularly if you have a limited amount of collateral or if you're having collateral as potentially an issue. And we'll look at that and we'll look at all the ways that collateral figures into the lending decision and the other popular aspects that kind of make up this wonderful thing of a small business loan. So we'll come up and devise some strategies for funding small businesses out of this. Weekly we have a little program we like to call our Capital Quarter. It's a weekly part of Webinar Wednesday. And today we're going to focus exclusively on that wonderful acronym you see right there. It looks kind of like an eye chart, but it's actually SSBCI, or the State Small Business Credit Initiative. And the State Small Business Credit Initiative actually is an acronym, or actually the acronym for that is a program that came out of the Department of the Treasury, the U.S. Treasury. We'll explain how that fits. We'll jump in slightly and do another of our weekly features, our Economic Corner. And we're going to just touch a little bit on economics and on the realities of inflation and the possibilities of recession. I know a lot of our younger Americans really haven't, until recently, the last couple of years, had to deal with inflation, but now they're looking at the impacts that it has not only on their personal life, but in their business as well. And also the possibility of a recession. We did have a brief, very small recession when the pandemic started, but really it goes back to the late 2000s, 2007 and 8, into the Great Recession of 2009, before we had a recession of a significant magnitude, and how it affects small businesses. We'll look at that. Our community events and happenings, we'll probably skip that. Really on the big agenda, at least as far as my calendar goes. We'll look at some of the news and resources, and we'll take your questions live today. Maureen Busherdang is our webinar producer, and she is manning our chat box today. So what you'll find in our chat is a lot of the resources that we talk about today, where you can grab and go with those from today. And also, little change of heart here. I figured we needed a poll today, so there is a poll questions, maybe multiple poll questions that we'll jump into at this time. So we're going to hit you with just two little, as far as I'm concerned, for me, it's market research on the fly. We're going to look at some of the needs and some of the challenges out there. And so we're going to start with the first poll question and launch that. And that is going to be, what is the biggest challenge your business faces in securing financing? Oftentimes there are a lot of challenges out there. Is it credit requirements or collateral? Could it be cash flow documentation or financials? So cash flow. Could it be the limited time or expertise that you have to research and apply? Is it the lack of awareness about programs, or is it something that is not on that particular list? So is it some of the 5 C's of credit that we'll touch on briefly today, such as credit or condition or collateral? Could it be cash flow? that your business has, or the limited time to apply, lack of awareness about the programs, or is it something other? So, first of all, we're looking at the biggest challenge, and we do have about 46% of you participating at this time, hoping to get a little higher up there. So, give you a few more moments to jump into our first of two poll questions, your biggest challenge. So, we have 50% of you. If we can just get a couple of others that hit that particular click, but we're going to go ahead and end the poll at 50% and share the results with you. And 29% of you, your biggest challenge is cash flow or documenting the cash flows or financials. Obviously, a big concern. 21% is the time or expertise or exactly knowing where to go. And that's something that we hope to help you with here at the SBDC because there are a lot of options out there and a lot of funding opportunities. But our number one choice at 36% was the lack of awareness about programs. And so we'll talk about some programs today, and then also bringing up the the last two were the credit requirements or collateral requirements or other issues. So your biggest challenge, thank you for sharing that with us. And we're going to go to our second poll question. And the second poll question is going to be your capital that is needed. So, what type of capital do you need most at this particular time? Do you need startup or funds to launch a venture? Do you need growth or expansion capital? Do you need to purchase fixed assets such as equipment, land, building, etc.? Do you need working capital, money to run that business, particularly permanent working capital that can be, money to pay wages and everyday expenses of the business and things like that? Or you're not seeking funding at this time. So, capital needs. What type of capital do you need right now? Is it startup? Is it growth or expansion? Fixed asset financing? Working capital? Could it also be you're not seeking funding at this time? So I'll give you another couple of moments to participate in this. This is a multiple choice. So unlike the first one where you only got one opportunity to pick, if there's a couple in there, like you want fixed asset financing and also maybe some marketing and product development assistance, you can select two. And we do have 62% of you that are participating. We're going to go ahead and end the poll, last second to get in and in the poll and share those results with you. And over half of you are looking for growth or expansion capital. That's great. Growing a particular business, expanding, exciting times. Another 47% are looking for startup or funds to launch a particular business venture. We have 35% of you that are looking for working capital. And then fixed asset financing, market product development, or not funding, those are the ones that bring up the rear. So really, the really key thing out of this is we're looking for startup, growth expansion, and working capital. Okay, well, thanks so much for that. That brings us a lot of help as we try to figure out the direction on the fly of where to spend most of the hour that we have with you today. So, our capital quarter, which of course is my new poster child, is former President Woodrow Wilson there on the $100,000 bill. Our capital quarter, a weekly feature as we talk about, and it's going to be dedicated toward almost all of it on the discussion of the loan program that's coming up in just a little bit and loan options that you might have as small business owners. So we just wanted to take a moment to thank you. We've been I'm sure many of you out there that have actually responded to the Small Business Credit Survey that is put out annually by the Federal Reserve Bank. And just a big thank you. And we're hoping we got our 50 survey responders that will give us a subset of data and really kind of help us find out how different we are here in Kern Inyo and Mono counties in the southern San Joaquin Valley compared to other parts of the US with the data that is presented on a national basis. So again, if you participated, a big thank you. If not, hey, do it next year, huh? Our economic corner, just a few moments on our economic corner. And really, just to talk about a few of the major factors that affect businesses that oftentimes are out of the control of small businesses. We've gone through some periods of inflation over the last 18 months or 2 years. We've gone through periods of supply chain issues in getting the parts and supplies that we need for our businesses. And so those are kind of a couple of economic realities. And really, the United States hadn't suffered some serious recession for several decades, going back to probably around the 1980s to where there was significant inflation. And unfortunately, we all got a real economic dose of reality in the fact that inflation is a real troubling aspect and a real troubling component of our economy. And one of the things that I think a lot of people, when you first see inflation and you see, say, the price of eggs or something, a product here or a product there that spikes in price and comes back down because of general, supply and demand issues. But inflation, what it does is it kind of raises the floor. And it raises the floor for a lot of products that do not come down in price. And that is something where I think a lot of us during 2025 have been sitting there going, okay, these prices have been spiking. When are they coming back down? And the cold, hard economic reality of that is many of those or most of them do not come down. So living with inflation and kind of getting it under control right now, and I think that we'll hopefully have some economic data out on inflation. I think the Federal Reserve came out today and said that there could be some data out in December on inflation. Those numbers were not kept up during the government shutdown, the 6-week government shutdown. And so the economic realities of inflation are something that we have to deal with in our business and in our personal life. The other economic reality that I wanted to discuss briefly on Economic Corner today is the danger of recession to small businesses. With small businesses, we have so many things that we can manage and that we can do in our business as entrepreneurs, as business owners. But really, when it comes to the general economic conditions, that is something we can't control. And it's something that can have a much more drastic effect on our business than those elements of our business that we can manage. So, really, the danger of recession, and one of them that we've talked about throughout 2025, it seems like the economy right now, I think most of the economists don't really have a prediction for a recession, whereas I think earlier in the year there was one. So that is an important aspect to keep your eye on because generally, once recession in the general economy constricts or contracts, is people get tighter with their money. And I think we're seeing that in some industries already. And really, both of those underscore is the importance of confidence in our economy for not only our small businesses, but also our consumers. One of the most watched statistics for small business owners is the confidence that they have. And the confidence that small businesses have are generally reflected in their ability to grow and expand their small businesses. So really, it's an important gauge. It's tracked, I think the most watched statistic is by the National Federation of Independent Business. Over our webinars over the years, we've looked at that number a lot. Not going to because of time today, but just to talk about the importance of confidence that not only for small businesses that allows them to have the confidence to grow and invest in their businesses, but also for consumers, because with consumers, it's the spending aspect. And really, we are an economy that's driven most by consumer spending. So those are three of the factors that we'll just touch on briefly. And then also add just that it's great that our SBA offices, our Small Business Administration district offices are open and serving small businesses. So on the economic side of that, there's your good news out of the other three. Looking at kind of a snapshot that the Wall Street Journal provided us, and this is the percentage over time, over this decade of a recession, the possibility or probability of recession. And this is gauged by pretty much by economists. And it's a global kind of look at what economists, so I think it's a collection of maybe 35 to 50 or 60 economists. And then this information is combined. And we really saw a couple of spikes. We saw one of them going through the mid 20s where there was a significant chance of recession that didn't happen. And then earlier this year, we saw, I think after the tariffs came out and a few other things, people got alarmed and saw that. So, whereas we stand right now, I think most economists think that there is about a 1 in 3 chance of a recession moving forward. So, one thing that I want to mention to you, and you've seen this slide is part of the AI University, AIU, through America's SBDC, our trade association that supports us centers across the country. And at in September, when this slide was presented, or this slide, major, huge slide, since that's our lead advisor, Jay Thompson, standing there. There's 24 states that are now participating in the student engagement projects that are working with over 150 students. We can add about 10 students working to that since this slide was presented, and definitely now at least 25 states that are participating in student engagement projects. This is part of a program with Google that is working to support AI with small businesses and get small businesses to adapt to AI, and also working with students in order to do that. And, we're rolling out a project now to where we have our student interns and that we are going to be working with small businesses in our community. If you want more information about how we can assist you and your small business adapt to artificial intelligence, um, contact us. There's our email address at sbdc@csub.edu. We'll be rolling this out into December and possibly after the first of the year, but it's really kind of a goal of ours is to work on some of the ways that AI can assist you in your business that maybe you're not thinking about at this time. We have our toolbox also that we talk about frequently, and our toolbox at the SBDC are tools that our advisors use, our student interns to help you succeed. The ones that are most pertinent to today's webinar, we're going to be, say, for example, our Live Plan. And Live Plan is a planning software interactively where our advisors can work with you on your particular business plan, get you some great, maybe financial projections and other things that can help you get loan approval. Another great tool down here toward the bottom that I am circling with my little cursor here is the Vertical IQ program. And Vertical IQ program is a program we use at the SBDC to help your business understand where it fits in your particular industry. So it's industry analysis and some great market-driven statistics and demographics, but also financially how your business is performing in your industry. I can tell you right now that when you go for a small business loan, if you're an existing business, we're going to show you a lot of the financial information your bank is going to want to see. And one of the reasons that is because vertical IQ can actually show you the financial aspect of your particular business. Your lender is going to look and see how your business compares financially. They're going to look at tax returns. They're going to look at financial ratios. We can provide that and give you that leg up before you even get to a meeting with your lender so you know where your lender is going to go with that particular issue. Another very vital reason SBDC advising is so important in this particular instance. So those are a few of the tools that we have that we look into and we jump into and kind of assist you in putting together the ultimate loan package and loan information to be and meet the needs of the lenders out in our community. Another one that we like to show off is our YouTube channel, and we're celebrating 500 subscribers. Thank you. We are over 500 subscribers at our CSUB SBDC YouTube. And below are some of the actually funding related. It says for me, you must know I like the small business funding ones. So we had previous webinars on, small business loans. We have on crowdfunding your business. Our event, the Eastern Sierra Capital Summit, I believe we had the East Kern Capital Summit on there as well. And some of the guaranteed and many other types of programs, but not limited only to financing. There are a lot of marketing. There are a lot of other aspects as far as workforce development, the economic aspects of running your small business, and so forth out there. So subscribe to our YouTube channel. Our free human resource hotline, and I should not say our, it is actually provided by the Central Valley counties that have partnered with the California Employers Association. These are mostly through your workforce development boards. There's a list of the counties you can contact and receive free human resource information via the hotline. Also, if you like our presentation for today's webinar, or if you're a client and have had great success, reach out to Google and give us a review. Review us on Google. If you've had an issue, I would like to take that up with you directly. If anybody that ever has an issue and nobody contacts me, so I'm assuming that there is not too many of those. So our SBDC sponsors, thank you all for allowing us to be here and to actually contact us or to contact us in our three-county area. There is our website, CSUBSBDC.com, and you can receive confidential, no cost, no obligation expert consultation. And now I would normally introduce our guest speaker, but he's already speaking to you. So let's get on with today's program about what is happening with this small business credit initiative. And first of all, it is not new, the state small business credit initiative program. It actually came out of some funding back in 2010. So what we're talking about today is the 2022 version, that is the 2.0. But one thing that they found out about SBBCI or SSBCI, however you want to call it, is that it results in about nearly $9 of new financing for every dollar. So leveraging this aspect really helps out. And plus, with the 2.0, they've added technical assistance, which allows us to provide even greater technical assistance for you in advising at the SBDC. So generally, when you go to a lender, and we'll talk about a lot of specific lenders today, but mostly those that are going to be focused on the SSBCI program, what do lenders need to evaluate a funding request? So for existing businesses, they're going to want a couple of years of your business tax returns. If you're already in business, you should have tax returns. You should be able to provide them to you. You should have also, like in today, it's November 19th, 2025. Obviously, your tax return's a little stale, so oftentimes they're going to want current profit and loss and balance sheets. So they're going to want current financial information, or interim statements, as they're also referred to as. And those are pretty commonly asked for once you get to about midway through the year and beyond. So then it's like, well, we have last year's tax return, but we're almost done with this calendar year. Can you provide us how you're doing at this particular point? And so that financial information there, both the tax returns and your current financial information, what you're going to see is you're going to see that, number one, when I talk about vertical IQ and industry analysis, one of the things your lender is going to do is compare your business to your industry. They have ways of doing that. They want to see how productive, how financially how your business is doing financially compared to your industry. So they also want kind of a business schedule of your debt. That will show up oftentimes on a balance sheet, your short-term and your longer-term debt. But they're also going to want a business schedule that kind of shows what is some of the existing debt that you have. They'll run things like financial ratios called like debt to equity ratios. The equity amount in your business divided by the debt that you're carrying. They'll also look at cash flow and how your cash flow actually on an existing or a projected basis is going to cover the amount of debt that you have, called the debt service cash flow ratio. So those are a couple of ratios, financial ratios, that actually do come out of vertical IQ as well, that actually can be helpful in analyzing that. Oftentimes, they're going to look for about 6 months worth of bank statements. Some lenders might say a bank statement or two, and some of them even longer. But they're going to want to verify through bank statements some of the information that is on there. Oftentimes it's interesting, but if you're leasing a particular building for your business operation, they're going to look for a copy of your lease. And oftentimes lenders will want a copy of your lease because generally, if they're going to give you a loan, the loan oftentimes is going to be 5 to 7 years. It's going to give you ample time to pay it off, make it really easier for you to cash flow that over a longer period of time. Kind of mix the assets that you're financing with the length of term that you're paying it off. So with a current lease, the reason they're going to want to see that is a couple of reasons. One, and the main is they're going to want to make sure that you're going to be able to stay in that business location during the entire length of the loan. So that's important, particularly if your location is extremely vital to the success of your small business. So having a lease, let's say you're looking for a loan and your lease is expiring next year, but you're looking for a 5-year loan. That's something you're going to want to start working on immediately because your lender is going to want to have you in a situation to where you control that property for the life of the loan. Now, you can control it two ways. One is through a lease, and another, which is kind of a more favored approach by me, is to actually have some lease options. So it's not uncommon for someone to lease a building and to lease it with a 3-year lease because a lease puts you in financial obligation to pay that back. So you're going to be required to pay that back for 3 years, but after 3 years, something might happen and you might say, gee, my industry's changed too much. I didn't use vertical IQ. I'm going to shut down my business. Well, if you had an 8-year lease instead of a 3-year lease with a 5-year option, then you're going to be on the hook for those other 5 years and needing to sublease that. So oftentimes a lease option will do that, where you actually have a 3-year lease and then you have an option to get another 5 years. That'll make a lender happy and they'll say that that's fine. So in addition, if it's an expansion, you might need a plan and some projections. So what these lenders are going to be looking at, and most of the programs we're talking about today are going to be made by small business lenders. They're going to be either community lenders, community banks. They're going to be credit unions who are very active in our community with small business lending. They're going to be also some maybe nonprofit lenders, some CDFIs. So we're talking about a whole spectrum of different types of lenders. So, and this is going to be generic and I think kind of a outline for most lenders for startups. Some lenders will do startup lending, some will not. The ones that do are going to want some financial projections that are forecast income and expenses for at least 2 years. Oftentimes, they're going to want a business plan that explains how you're going to make money, how you're going to pay back their loan is really what they're looking for. They want to see with those financial projections how you're going to be able to pay yourself and also be a successful business. They're going to want you to have some injection. That could be money or property. It could be as little as 5% in some deals. It could be up to 30% in others, depending on the lender, the program, the guarantor, the guarantor for that particular loan, and other things. If you haven't signed your lease, and really kind of the one thing, if you're a startup, we really don't like to see you go out and get a lease before you can get funding for that. So work with your landlord and say, hey, I just need a letter of interest that you would, and the terms that you would give me this, and I am going to take that and go get some financing to where we can secure and lock up maybe a lease with potential options after the expiration of that initial lease. If you've got any leasehold improvements or construction, you might need some bids, you might need some equipment invoices, purchase orders, etc. If you're a franchise, a franchise is going to bring into a number of other restrictions or other documents that are going to need to go into your loan request, and that's a franchise agreement and a disclosure agreement also. So one key thing is when we get into actually the ownership needed, um, is that the personal information that is going to be provided to the lender, you're going to have your business information, personal information, but really 20% is the magic number. So let's say, for example, that you have five partners that are equally going into a business. So those five partners are all going to be 20% owners by theory here, and all five of them are going to have to provide this information. They're going to have to provide a personal financial statement, and also they're going to have to personally guarantee the loan. So everybody, 20% is going to have to personally guarantee the loan, provide their financial information, and also qualify from a credit standpoint. So we see a lot of instances here at the SBDC where, let's say maybe a little different example for this ownership is that I have friends or family who want to invest in my particular business. They realize I need the equity ownership and they want to give me, say, some cash in order to maybe get some debt or other things. But that's going to be the limit to what they want to be involved in this particular business. So staying under 20% is essential. So they might provide you with potentially what looks like a quarter of the ownership of that, but really they're going to need to be in the 15 to 16, 18% range in order to keep all of these key things from checking off. And the main one's going to be to guarantee any debt. I have people come to me and say, hey, I want to help. I believe in this project. I want to invest in it. I don't want to be responsible for the loan or anything that comes after it. I know what I'm putting into it. And at 15% ownership, I'm fine, even if it really should be more than that. So that's kind of an opportunity for businesses. So when lenders get into this evaluation and they really want to look at the five C's of credit, we're kind of highlighted collateral today because collateral can be a sticky point in for a lot of particular deals. And there are some options out there to really alleviate and to really get loans funded that are light on collateral from most lenders' perspective. And we're going to go through that. But there are generally how lenders evaluate a loan is they look at the five C's of credit, and collateral is one of those particular C's of credit. And in some of the examples that we're going to be showing you are how to get a loan approved when your collateral is a little bit less or reduced. So on lower amounts of collateral, we are going to need to have these other C's in pretty good shape though. It's really hard to find somebody who's perfect in all five of these aspects as far as the character credit, having sufficient cash flow, having the collateral, the capital, and condition of the business and the industry. So, you need to consider the strengths and weaknesses that you have here and be upfront and honest and address those with the lender when you're going through the lending process. So let's look at these five threes quickly. Okay, well, let's just look at them, get in a little bit more depth here. And really, let's go into the collateral aspect first. There we go. So one program that we're going to be talking about is the CalCap program. It's a program through CalCap, which is an acronym for the California Capital Access Program. And it is housed at the Pollution Control Board for the state of California. So CalCap was a program that came around in 1994. I remember it back then. We used it kind of extensively. It was really a good little program. It became part of the original SSBCI through the SBCI 1 in 2010. And then in 2013, they established a program seeing that some deals needed additional collateral to make them happen. They established some of the funding through this program for collateral support. And so how the collateral support on this works is that basically your lender will say, gee, my client is a little bit light on collateral, and they will come in and guarantee some of the support aspect of it. And then in 2022, SSBCI returned. So SSBCI in a nutshell, we have two basically entities from the state of California. We have the iBank and we have the California Pollution Financing Authority. And so what they do is they both work to mitigate the risk and enhancements of some of the programs and some of the small business programs. So there's two programs that are done through CalCap. One is the small business program, which is kind of a quick process. It's popular with institutions. Remember, these are not direct loans through these entities. These are going to be lenders that work with them throughout the state of California. And they're going to be working in this. There are some that do guarantee programs. We have a good list and good knowledge of those that are wanting to do deals in this particular area. So for the small business, goes up to 5 million, but typically those are going to be your smaller loan deals, and we'll look at some of the approvals on these as we move forward. Also, the small business loan guarantee program, or excuse me, the collateral support program, first of all, is one that we've just started talking about, and it's ideal for a business that's in a good position to obtain a loan, except for low on collateral. And so they do have programs that roll up to 20 million. I haven't seen a $20 million deal. We have seen some seven-figure deals, and we've seen some that are significantly less than that. So, they'll go as low as your particular lender will go. Some of the smaller ones, I think, get rolled up more into the small business and for CalCap for small business and other small business lenders that do these smaller microloans and also lines of credit. And then there's the collateral support through CalCap. The state of California has a small business loan guarantee program. It's administered out of about 7 regional offices throughout the state of California. And now they have the total technical assistance to get it right. So a lot of our collateral friendly lenders that we work with and we see, and those are going to be our local credit unions and community banks. Our credit unions here in Kern County are going to be Valley Strong and Alta One credit unions, and community banks that work in here in Kern County and other elsewhere. It's also going to be your California CDFIs, your California Development and Financial Institutions, and other nonprofit lenders that are going to work oftentimes with lenders that are a little bit light on collateral. As a rule, the SBA does not require collateral, but since the loans are made directly by a bank, there is generally a provision for collateral, and oftentimes certain SBA products can be actually done with less collateral than what lenders look at as ideal is a one-on-one basis. So when we're talking about collateral, we're talking from a lender's perspective. If you want a $100,000 loan, what they're looking for is $100,000 in either business or personal assets to cover that loan. That's one-to-one coverage as far as the collateral goes. Oftentimes, lenders or borrowers are going to be lower than that, and it's going to be oftentimes predicated on what is actually being financed. When fixed assets are going to be financed, if it's equipment, or if it's going to be land or buildings, the collateral is kind of built into those particular projects by the very nature of those fixed assets. However, with working capital, there's very little inventory or leasehold improvements. There's very little collateralization value there. There's not really something that a lender can grab and particularly sell if they need to. So though it makes it harder and really kind of brings in a lot of the personal assets that oftentimes that we see that have to happen in order for a deal to get done. So it's really done on a deal by deal basis, and it's really done on a loan product by loan product basis as well. So just quickly, those 5 Cs, and going into, some of the character credit. Obviously, credit score is going to be looked at and analyzed in most programs, but not all. Most programs will want to see a payment history. So it kind of runs on a deal by deal basis, but generally you're going to need to be in the 600 credit scores for most of these programs that we're dealing with. And again, anybody over the 20% is going to have their credit and also looked at. When we looked at our 5 Cs and we looked at cash flow, we were also looking at the business income aspect of it, some of the personal income that can come into it. So they look at a thing called global cash flow. You'll hear global cash flow because that's not only cash flow generated by the business, but it's also cash flow that comes in from outside of the business. So it's that personal income, and oftentimes that's having a spouse working out of the business. It could be other business income or other monies that come in. We like to look at our cash flow on this wonderful little cash flow forecast for looking at particular businesses. So when it comes down to collateral, and necessarily in the forms of collateral, when we get into the personal aspect of things, oftentimes it can be your personal residence. And when that comes into play is when there's not a lot of business assets for collateral, and if the collateral is available. One of the key aspects when you fill out a personal financial statement is going to be if there is sufficient collateral. And if there is sufficient collateral, many times a lender is going to ask for it. So be aware of that. And remember, again, we look at different things. We look at, and by personal residence, it can also be a residential, it could be a rental property, it could be real estate. So it can be real estate that's owned by the individual, not necessarily have to be the personal residence. So the business assets, we talked about that. Oftentimes, how a lender will collateralize those is a UCC, which stands for the Uniform Commercial Code, state of California, and through the Secretary of State, they will file a UCC-1 filing, and that'll be filed against the company and state that they own the assets of that particular business. So when the assets are softer, when it is mostly maybe accounts receivable, it can be inventory, it can be other assets that are non-fixed by nature, that UCC-1 filing will be actually a filing that is made. And then the personal assets, sometimes we see a personal vehicle, we see other personal assets that come into play. We've even seen relatives that actually pledge collateral, and actually some lenders will do that. So there's a lot of different ways of getting around the collateral issue. When we hit capital, as generally, if you're going to be light on collateral, we're going to be looking at a one-way shape or form to fund some of the options for being light on collateral. Generally, we're going to also need a stronger capital position. So that's going to be either money or property that is donated into the business to meet a need. And let's say, for example, it says at the bottom here, for startups, it's 5 to 30. Let's say 20%. I like the 20%. So we have a $100,000 project. Oftentimes the way those will work is that you have 20% that is either injected by you through the form of cash, family, friends. You can crowdfund the project, savings, whatever. Partner contributions, kind of touched on that. So a lot of different ways to do that, but it can also be assets that are going into that business. If you have tools or machinery or specialized equipment that goes into that and has a valuation, that can be put into the business and collateralized by that UCC-1 filing we just talked about. So you're going to need to be fairly strong on the collateral and the other C's if you're going to be weaker on the collateral position. But again, all of this is subjective. It is the lender that we're talking to. It is their program. It is their emphasis at the time. And this is all changing rapidly. It's a rapidly changing environment. And lenders sometime will do a deal that they won't do 6 months later. So there's a lot of variables that go into all this. When you get into the business acquisition, which we think is a great way to get into business, if you do your due diligence and look into a business that's out there, it's a great way to grow an existing business by an acquisition. Oftentimes, the minimum injection can be 5 to 20%, and we've even seen deals that have an injection of 0%, but we're not getting into that right now. So condition can also be the condition of your particular business, the condition of your industry, getting back to our vertical IQ and how it can benefit you, looking at the condition of your industry, but not only now, not only today, November 19th, 2025, But 4 years from now, when you're 4 years into a 7-year loan, your banker or your lender will look at your particular industry now. There's rapidly changes that are going on with businesses and their industries. And there are trade associations that lenders uh, rely on to provide them with estimates of what's going to happen in the future. So not only the current condition, but also looking at your condition moving forward. We have some projections based deals and some other things that we can look into, and some lenders will do projection based deals. And that is, you don't have the financial background. You don't have 2 years of taxes and profit and loss statements from your business. You're a startup, or you're a growing business, or you're adding a location, or it's an acquisition. So a projection is going to be, what is that business going to look like to a banker from a financial perspective? How can we list some assumptions and come up with how that business is going to perform? And then your lender will look at those assumptions. They will see if the assumptions are valid and believable from their perspective. Look at that and then move forward and proceed onward. So, getting back to some of the programs that we have and how they work, CalCap for small businesses, they utilize a loan loss reserve program. So, oftentimes, borrowers or the lenders will need to put up to 4% into a loan loss reserve fund, and then that loan loss reserve fund pays off the loans that go bad to the lenders. So it's been around for quite a while. So it's been working great. I believe the loan loss reserve fund is 4%, and then each individual lender has their own requirements. Sometimes they match, sometimes they don't, and sometimes the borrower must kick 4% into that. As far as the collateral support for CalCap, remember CalCap, it's an acronym for the California Capital Access Program. And so the collateral support for this is to provide cash support to financial institutions. Remember, third party lenders are making these loans. Our loans are credit unions, our community lenders, and nonprofits and others in the community are making these loans. And even big banks. For a long time, one of the big banks was very, very instrumental, but going back to the 1990s in CalCap. So what this does, it provides them with the security for them to make the loan, knowing that they can come back to CalCap for that collateral support that is light or missing. Okay, so a lot of times I really like to kind of get into, what are some of the successful applications? I think this is really a good way to see. And a lot of this is early on in the new SSBCI 2.0. Maybe some of this has changed a little bit, and we'll see about that. But really kind of getting into a lot of what's going on, and I'm going to use the whole Central California SBDC region and projects within that region. What we're seeing and what they've seen from some of the data that has been produced by CalCap through these particular programs. So we see the trucking businesses that have been using the program quite a bit. A lot of different uh, types of trucking businesses, but trucking businesses, we've seen a deal in Fresno County that actually worked toward expedition and crop removal. Again, that's a smaller than a $50,000, so kind of a micro. But what it did was allowed them to purchase inventory, and this would have been one of the CalCap small business loans, where they were able to maintain 8 employees with the $50,000 purchase inventory. Some of the other deals with the collateral support, these are a couple of bigger deals with collateral support, but again, as I mentioned, there are smaller ones that take place as well. In Kings County, there was a fertilizer manufacturer that went in to purchase and did a building in commercial real estate, a significant project that created jobs. Whereas also in the central part of the state in Monterey County, an ag producer, wholesale distributor, was looking for working capital and was able to get working capital to maintain and retain their 37 jobs and add some more. But again, they might not have had, especially for working capital, because remember, working capital doesn't really have a component of it that lends itself well for collateral. So the working capital side of things was able to, they probably had a limited amount of that. So they had some amount of that, but then they were able to get the enhanced actual collateral support through the CalCap program in order to do that. Some of the funding projects locally here in Kern County as nursing facilities were some working capital, again, smaller size deals, but $50,000, a little under 50,000, which kind of maintained two jobs. Madera County, kind of another smaller size project, again with working capital, but these are small business projects that were funded. Tulare County had some mobile food businesses. In Fresno County, a landscape business. Again, equipment, working capital. And so ways that on a smaller scale with the program, it kind of works and works well to a particular advantage. A couple more examples you see there. And also in construction, something on the Central Coast. As we stay in the entire central region of California, these were construction type where we see a couple different programs and actually construction projects that were funded. And all different kinds. Okay, so that wraps up our capital quarter aspect. And we're getting a little bit low on time. So what I'm going to do is I'm going to give you an opportunity to answer some questions at this time. So let's go to the Q&A and go to the chat. I don't see anything in Q&A at this time. So if you have a question, go to the Q&A box. If you've put it in the chat, we'll go in there and see if we can find it right now. And in our Q&A or webinar chat, we have resources such as the SBDC where you can sign up. And also, if you're looking for a loan, okay, there's a question. What if you're looking for a loan to relocate into a better facility, but is in the same municipality? So, okay, so if you're looking to relocate, which is oftentimes easier with a lot of government programs, because a lot of them in California, they don't work well with trying to move from one local area to another. Looks like you're looking to stay into the same area. So what if you're looking for a loan to relocate into a better facility? So if you're looking to rent a particular facility, then I think that the program works well. And I think some of the programs that we probably identified after you asked the question. So again, reach out to me specifically if you want to talk about it in more detail, but it does work for both. If you're looking to borrow and move into a facility, there are other programs for that, such as the SBA 504 program, but there are programs that we've seen with CalCap that will look into that. So also with CalCap, where we see in the chat, we see the treasurer, we see some of the credit reports. We recommend at the SBDC keeping an eye on your credit report and understanding what it is, and using one of the free ways of doing so. And annualcreditreport.com is one, and there are others. So you can Google that and find free credit reports and take advantage of that. CalCap for small business, there is the Treasurer's Office of the state of California where the program comes out of. More information on that particular, there's a Google Returns. And next question was, will recording be sent out via email? And yes, a very consistent trend that we have is to send you not only these resources that we're going over right now, so you have another look at these resources, but we'll send out by the end of the weekend a lot of the information as in even this video again. And you can find this video again on YouTube probably by about the end of the weekend. But by the weekend, usually we try to get the recording out with the links. Nate, thank you. You're very welcome. Thank you. And it's very nice to hear from you. Best way to get startup funds to start a small business security funds. Well, again, there's going to be a lot of programs. A lot of small business programs are really predicated on loan amount. So we have programs that work exclusively $50,000 and less, and some that really begin at $100,000. So it's really kind of the amount that you need is really the first place to start. So really starting with that and really understanding what you need and the amount that you need, I think is really the first key step. And when we do that, we really, at the SBDC, we really recommend that you do two different ways of analysis on that. So the two ways would be one is what is the optimum amount? What is, if you could really just, what is the ideal way to fund your business? How much money? Uh, and then really the second one is because larger amounts, the larger you go funding wise, the harder it is to get the loan. So with that, we also ask a borrower, well, gee, then what is the amount that you think that you could get by with? And I hate asking that question because what it does is I don't want anybody to be underfunded when they start a business. So we want to get you enough money to where you're sufficiently funded, but not too much to where it feels that with the lender that you're asking for an excessive amount. Okay, so I hope I got that question answered. Moving through, new LLC, been adding inventory, take the larger step, have looked at personal credit and doesn't seem to update the progress of the loan to business. Um, so can you get me a lender that would at least report to the business credit, even if it's backed by my personal credit? So I believe what Eric is asking for here is there is business credit, and there is a way to establish business credit as a alternative means of applying as an individual or personal. Uh, for smaller businesses, it is less common, significantly less common, but there are ways of doing so. And I think by signing up at the SBDC and talking to an advisor, this is where it really gets into the weeds and where it's a lot easier to sit down and go through a lot of different options and variables that you have. So that would be my best answer in a short period of time for that. So the question is why not hire someone to crunch the numbers and have them teach you on how they arrived at the numbers? That's a good way of doing it. We have advisors at the SBDC that can maybe work with you as well. However, um, lenders really what they want to do is they want you really do need to know your numbers, and putting it together isn't something that they expect you to always do. So either by hiring or by using a technical assistance firm in order to do that would probably work best. So I think either way, honestly. What lenders don't like to see is this. They don't like to see you come in with an AI generated business plan that they can clearly see as AI, that you aren't invested in or don't know what's in your business plan. And they want to make sure that you know how you're going to make money in your business. That's essential. You've got to know how you're going to make money. And oftentimes, when other people do that, you are not fully aware of how you're going to make money. Really, one of the most important steps of a financial projection, the most important step is the assumptions that you use. I used to like to say that I can do a business projection for you, a financial projection. I can project every single one of you are going to make $1 million in profit next year. But it's going to be based on my assumptions that I use. And my assumptions might not be valid or believable, which are two things that you have to get in that respect from a business lender, or you're going to see a no. Okay, that looks to be the chat box, gone through it. Um, got a couple questions. And what if you want to build a facility? I have emailed and haven't been able to get in touch. Well, I hope that's not with us. But you can email me directly. You want to build a facility? Email me at kbearden, Bearden, at csub.edu or sbdc at csub.edu. and I will contact you directly. Startup business from July 2025, and I don't have financials from the previous owner. My financials show me operating in the red. Will a bank consider a business loan? Okay, so I'm a little confused here because it says you're a startup, but my financials, but you don't have financials from the previous owner, so that makes it sound like it's an acquisition that you bought it. So I view those as slightly different. Startup is when you just start it up and run with it, whereas if you're relying on financials from a previous owner, most likely you purchased it um, or took it over in some way, shape, or form. Um, you know, if your business is operating in the red, what a lender is going to need to change that no to a yes is going to be essentially, it's going to be what are you going to be doing differently to do that? And maybe it is the capital. Maybe you're undercapitalized and underfunded. And by putting $50,000 in inventory, for example, or some other way, but it's going to come down to those assumptions that you go into and to actually show that. And it's going to really take that leap of faith from a lender in order to actually buy that whole particular scenario. So, yeah, absolutely. And yeah, that was a purchase, acquisition on that. So, thank you for updating me on that. Um, you know, I always prefer vastly, enormously, mammothly that we get to talk to people before they buy the business. Um, but that's not the case here. So oftentimes, sitting down with an advisor and kind of looking at the situation you're in and maybe how that can actually translate. But oftentimes, a lender is going to want you to turn around and at least get the business to a break-even proposal. And there could be some add backs. Oftentimes when lenders look at financial projections, if you've had any capital purchases that should have been depreciated, for example, when you bought a service delivery vehicle and that's in there. So there's a lot of different things that can come up and a lot of different ways to lay that out. Okay, we're out of time. But thank you for for joining us. Oh, one last question I see. Good place to start to find a lender or investor. The good place is to start with an SBDC advisor and to start with some background as far as a business plan and some financial information and a plan in order to meet with a lender and find the best lender for your particular need. Short and sweet. Okay. Will we be back next week? I don't really know. It's the day before Thanksgiving. We have been live the day before Thanksgiving, the 3 years during the pandemic, during the prime years of the pandemic. But we'll see. If not, we'll be back on December 3rd. So for our producer, Maureen Busherding, I'm Kelly Bearden. Goodbye, everybody. We'll see you next week. Have a great business week and be profitable, my friends.